In China, there were 39 VC and PE-backed IPOs in Q1, and that's out of 110. And that's a dramatically larger portion than we've seen in the past here. There's also a tremendous amount of liquidity in China, and I think it's very fair to say that, that later stage valuations and competitiveness in China is at or near an all-time high, but so are the opportunities there. We've seen in our own portfolio a number of very important companies that are emerging and taking advantage of the huge consumer population and the Chinese government's recent efforts to stimulate domestic consumption as opposed to the export environment, which they were favoring as recently as a year or two ago. I'm going to skip over the environment in Japan, except to just make one or two comments here. There's a burgeoning new class of entrepreneurs in Japan, and they are now, I think they're the biggest trading partner of Japan has shifted away from the US, and it's now China. They're very actively involved in the international marketplace, and there are very few Western-style venture capital organizations operating in Japan. Remarkably, they still admire the US, and they still are trying to copy the successes, and they want to have a flourishing venture ecosystem like we have here, but it's taking them a lot longer than they would like to see, but they're making slow but steady progress toward becoming a bigger factor in the global venture market. So let me wrap up my overview remarks here with some reasons for optimism. Innovation is clearly flourishing all over the US as well as globally. If you don't believe that, then you shouldn't even have come to this conference. We have the smallest early stage uninvested capital overhang on the record as far back as records have been kept in the venture industry, and I'll show you a chart on that in just a minute here. Venture capital commitments as a percentage of the stock market cap are back in the historical ranges of 0.1 to 0.2%. We have a gradual reopening of the IPO window, as I indicated. We have rebounding M&A environment, which is there were the most venture-backed M&A exits in Q1 in any quarter in record in the history of the US industry here. Venture provides investors a call option, on the potential value creation associated with IT, healthcare, and clean tech advances, and no other asset class can give you that. And then you finally have I guess we'll call it the right sizing of the venture industry with a shrinking of new LP commitments and balancing supply and demand here. This is the plot of the cumulative percentage of early stage capital that's uninvested here, and it's declined from 50% all the way back. I can't read the chart. I think that's an 85. So this is like a 25-year chart. You can see we're down to the point where we don't have a large amount hanging out there now. Number of deals, that have been, compared to VC raised, the percentage of the stock market cap has been ticking back down to the bracket on the right-hand side here of 0.1 to 0.2% of the stock market capitalization. And if you look at the cyclicality here, and I'm going to do that as I wrap up, you're going to see that we've gone through these periods of boom and bust in the past. I came into the industry right after the first bubble popped over there way on the left, associated with way too many disk drive companies and PC vendors. And then we have gone through the other cycles that we're completely familiar with, including the mega bubble popping of 99 and 2000. So if you look at the returns associated with the industry on a cyclical basis, and plotting the percentages of venture returns associated with the top quartile going all the way back to, I believe it's late 1960s when this data was initially beginning to be capped. So you had the period associated with the bottom of the cycle here. There were a number of very poor vintage years in the 80s, but as things began to turn around then, we came back here as venture recovered, and we went through the extremely outstanding performance that the industry provided in the period of funds that were started in the late 90s. Then off on the right-hand side, you see the dismal returns for the last few years in the industry, and you all have to just decide for yourself. You're all professionals about whether you think the industry is going to rebound again. It can rebound again. I think it will rebound again, and if you believe that, you're going to see a resumption of some of the excellent performance of the upper quartile groups here as we go forward into the next few years. Just to make that point even more dramatically here, I have to remind, and this chart I borrowed from some of my friends at Knightsbridge, so I'm out trying to do good for the industry, not steal your data. I think your point was very effective and I appreciate it. So when you look at the returns of the funds that had been started in the 1980s, at the vantage point of 1990, this is like 6 years or so after all of them were started, they look pretty terrible. However, because of the cyclicality here, and if you wait and go fast forward 8 more years and look at how those funds played out between the point in 1990 and 8 years later, look at what happened to the returns. They got very, very, very interesting and very much the kinds of returns that LPs would like to see. So it's up to you to decide, I guess, as I wrap up here, whether you think the industry can return to its former positive state. And I think if we can somehow prevail on our friends in Washington to help us and to use some of the work that the NVCA has put out there as their jobs creation strategy, which we haven't heard a single peep out of, then we have a decent chance to protect our industry and maintain our international competitiveness before it's too late.